Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. Oil producers recommend a production cut just hours before the OPEC meet begins. No consensus on the quantum as yet. The RBI's dovish comments prompt brokerages to predict a pause on interest rates over a longer period. Some expect a change in policy stance in the next meeting itself. Bankers forewarn of some short-term pain when the new loan pricing regime comes into effect from the next fiscal, except that it will lead to greater transparency. The cabinet is expected to take up a proposal seeking to sell government stake in REC to the Power Finance Corporation today, reports PTI. And the SFIO blames former ILNFS officials for the company's downfall, claims group companies lent to each other to repay loans sometimes raised from the same lenders. And frankly, the markets would turn out to be the biggest headline today, arguably turn out to be the biggest headline today. Now, what's happened? One of the many things that add fuel to fire, I think what brought the US futures right into the limelight and a big drop out there amongst sentiment was that the Huawei finance chief, the chief finance officer, has been arrested in Canada for extradition to the US. Frankly, if you log on to Bloomberg.com, BloombergQuint.com, or any of the global websites, you will see that the top news is this. And at a time when US and China are trying to get trade tensions to ease, this doesn't quite add up. Huawei is a giant in China, and that the CFO being arrested would evoke sharp responses. I think a clutch of opinion that is already there on the Bloomberg website or on the Bloomberg Quint website speaks about, or global opinion speaks about how if the charges are serious, then the US will not blink, and that will not go down well with the Chinese authorities. So that's taken center stage. As a result of that, over the last 8 hours, the S&P 500 futures have come off. They may have stabilized a little bit from the opening lows, but they've come off quite sharply. Remember, the US markets were shut yesterday, but the futures are not looking all that pretty. And I reckon that, plus just the general sentiment weakening over the last few days, has led to the Asian markets starting off on a very weak footing. The Nikkei is down about 1.7%, Shanghai down about almost 1%, Hang Seng 2.2%, and the SGX Nifty, which has anyways been weak the last couple of days, is showing another downtick of close to 1%. So 85, 86 odd points in the red. Will start off at 10,745 at least, if not more, at the start of the trading day today. Frankly, if you just look at what traders have been doing as well on our markets, remember yesterday we spoke about how the call put distribution seems to suggest that traders are not shy from betting on the 10,000 put as the faraway strike to watch out for. But that strike has some really large build-up, and that continues. And yesterday, very interestingly, we saw a fair bit of short futures on the index as well. So if you just look at what's happened on index futures or index options and stock futures and stock options, fair bit of short positions and on all, but more importantly, index futures as well. So the sentiment certainly sour. Let's wait and watch how much further. It's very difficult to predict these things. So I don't really want to go out and talk about how this will be only a 1% or is this a trend or so on and so forth, because if something changes globally materially, it could well change as well. So very difficult to kind of speak about a trend. However, what is relatively easy to do is try and figure out what are the stocks in amidst this mayhem that could be in focus today. So 3 or 4 that I thought are the most important ones that we should bring out today. Firstly, the Mint reports that key investors in Mindtree are looking to sell stake. PE firm KKR might buy, but that notwithstanding, IT a defensive bet. But if indeed this rumors or this talk of key investors wanting to sell stake takes center stage, then we might see some weakness in Mindtree, I presume. Do watch out. My assumption that the stock could start off slightly weak today. Let's wait and watch. What could definitely start off week today is Deepak Nitrite. Now, this is not news. This is not new news, but we observed it yesterday that phenol prices since the start of November have dropped by about 27%. In the last 4 or 5 days, these prices have come up about 6.7% to be precise. Deepak Nitrite have kick-started the phenol plant, a very large capacity. They were banking on the spreads being fairly high for them to make money. The fact that the prices have come off 27% definitely dents the profitability or future profitability for Deepak Nitrite. Let's wait and watch if there's a further reaction in this stock. 2 days ago, it was at 260. It's already shaved off about 5-6%. Let's see if there's more in store for Deepak Nitrite. Couple of other brokerage notes that I thought we should bring out. So one is Macquarie's bullish bet on Siemens. They have double upgraded the stock to an outperform rating with a target price of 1128. They believe that the valuations have improved materially, and they have raised, of course, the FY19 and FY20 EPS estimates by 14% and 13% respectively. So earnings upgrade, valuations pull back, a double upgrade on Siemens. Do watch out for this one on a dull day. Can this start off well because of the double upgrade? We'll get to know. As also CLSA's view on HCL Tech. Now, it's an interesting note because CLSA is going out on a leg and saying that it is their top buy in the IT space. The price target is at 1500. A clutch of very important positives, including mega deal wins, IP launches, and a very low price to earning multiple compared to the top tier IT space. Remember, Wipro is at life highs or 52-week highs. TCS and Infosys always traded higher premium multiples. HCL Tech somehow has lagged 12 times, 13 times. In some cases, some people would believe even 11.5 times. Anybody's guess, but lower P multiples, and that makes HCL Tech the top buy at CLSA. Let's wait and watch if there is some resilience here in this counter. In yesterday's session, remember, IT was the only pocket that did reasonably okay for itself. Let's wait and watch if today is yet another day of gains for HCL Tech individually. So those are a few stocks that I believe are really important. The markets will start off lower. However, let's tell you what's lined up on First Word today. That's the collection of the top editorial stories that we believe we should bring to you first up. Firstly, RBI asks banks to peg floating rate loans to external benchmarks in a bid to bring in more transparency. We get you what economists make of the move. The government's looking at a 15,000 crore bounty by selling its stake in REC to PFC, but not all stakeholders may be happy. A very short analysis of what this could mean for both the companies. FMCG giants have been busy on the deal street, but the real competition is for a larger pie of the malted drinks market. Agam Vakil will tell us who's in the lead. And analysts have downgraded earnings expectations from Indian companies once again. Sameet Sarkar will tell us how wide and deep the cuts go. The first piece, a bit of a take on yesterday's policy. Remember, it came in at the fag end, the discussions, therefore not many people would have caught on it. But the Reserve Bank of India has asked banks to link all new floating rate loans to external benchmarks. The new loan pricing formula will apply to personal, retail and small business loans starting the 1st of April. RBI announced the change along with the monetary policy yesterday, but final guidelines will be only issued by the end of December. The regulator argues that this will lead to greater transparency. Bankers, though, have already warned of short-term disruptions. Here's what Sajid Chana of JP Morgan and Saugata Bhattacharya of Axis Bank make of the move.
So this is good. I mean, I'm not talking from a representative of a bank.
As an economist.
As an economist.
Yes.
So I mean, they have been talking about this for a long time. That, I mean, there needs to be more transparency for SMEs and retail borrowers from banks, because there's a certain asymmetry in negotiating power and transparency. So I mean, this is good. And not just this, coupled with the other measure on working capital and term loans being linked together, I think this induces greater market discipline, greater liquidity management, greater risk management, finer pricing, etc. This can actually serve to develop the term repo markets, because remember, whenever you are looking at a granular level of pricing, and this is obviously a pricing issue that comes in order to protect NIMs from fluctuations in the markets, you'll have to do much better and stringent liquidity management. You'll need to do better risk management. You'll need to use products, risk management products. You'll need to bucket your loans. You need to shorter term loans. So the term repo loans that we have been struggling to get moving, this might actually have a positive impact on the term repo markets. From a corporate point of view as well, from the other, I mean, I'm talking about the working capital and the term loans. Yeah. So corporate will need to do much better liquidity management than they have in the past. So, I mean, one part of this liquidity story that we had been talking about is the provision of liquidity. The other side, the obverse side of this, is better liquidity management. And these are the measures that are designed to create that, incentivize that liquidity management.
Sajid, how do you see this, particularly the former, in terms of pricing being linked to external benchmarks? Bigger issue is transmission, which we've, as I keep joking, it's my career has gone by without a final answer coming to that.
Well, I think you got a big answer today. I think it's unambiguously positive. Completely agree with Shogato. I think, A, it brings much needed transparency. And B, I think it will expedite transmission to have these transparent external benchmarks to which you link. Now, banks may say that this at the margin increases interest rate risk because my asset side is tied to an external benchmark and my liability side is more sticky or locked in. And this is where, as Shogata hinted, you have to use risk mitigation tools and begin to hedge that interest rate risk. So I think this is a very positive step in the right direction. And the more transmission that central banks can be confident of, then these long and variable lags of monetary policy that we talk about, by definition, get shorter and less variable. I think it just helps the whole system.
Well, we'll also talk to SBI Managing Director PK Gupta about what the new lending rate framework means for banks. That's a discussion at 9:45 a.m. today. You don't want to miss that. Next piece is on the government likely to ask Power Finance Corporation to buy its entire stake in Rural Electrification Corporation on REC, a U-turn of sorts from what had been floated earlier. The cabinet is expected to take up the Power Ministry's proposal today, and once cleared, would fetch the government close to 15,000 crore rupees. But not all stakeholders may be happy with this merger. Now, what is this about, and what could this do? Now, the deal has, of course, turned on its head. The new proposal is that PFC may acquire REC. Remember, the earlier plan was for REC to buy into PFC. It's likely to fetch the government, as the lead-in said, about 15,000 crores. I would reckon that the deal is very similar to ONGC's HPCL purchase. REC, by the numbers, well, the government stake is about 58%, and this is where the earlier deal was maybe more favorable for the government, because government has a larger stake in PFC, and if REC would have bought over PFC, that would have brought in more money for the government. Be that as it may, the current proposal, REC to be acquired by PFC, REC, government stake about 58%. Good numbers for REC, good numbers for PFC as well. It's a company that is doing reasonably well for itself despite the issues surrounding the power space. The book value, while it's come off, the price to book has come off quite a bit. It is still in a reasonable range. The capital adequacy about 16%, return on net worth about 21.5%. So nothing wrong with the numbers per se, both for PFC, REC. Nothing wrong with the cash and the reserves, again, for both the companies, which is PFC and REC. No issues out there. And frankly, as I said, on a valuation front, it is a lot more reasonable for both the companies. So if you just look at price to book, which is how you'd probably value any of these companies, be it PFC, REC, or any of the other companies in the power financing space or otherwise, the price to book will be the valuation multiple through which you will rate them, and you will see that they have come off quite steadily over the last 18 months and has come off quite steeply in the last 10 or 15 odd sessions as well. However, what would not make the markets what would make the markets unhappy, or select set of shareholders, the minority shareholders, unhappy, is because these companies were probably doing the best that they can. They are both well capitalized, they are both profitable, and this merger is a bit of a needless disruption to ongoing business, and arguably it's not the most efficient use of cash and reserves, and which is why, from a minority shareholder's perspective, I don't know how they will be taken. Remember, the stocks have come off quite a bit, but once this deal is announced or otherwise, it's very difficult to believe that there is the market believing that there is a synergy in this which will help the stocks gain substantially from these levels. As it is, you will see PFC correcting quite a bit in trade yesterday, because the inkling of this was anyways there in the market yesterday. So that stock was down about 5%. But frankly, as I said, it's very difficult to presume that there could be some positives that could come out of this purchase. We'll get to know about it when the cabinet clears this, but sources and the PTI copy on the Bloomberg websites firmly suggest that the cabinet clearance will come in today, and this is a go. The ratios, the swaps, etc., all of that will be known later on. But that notwithstanding, it's not a win-win deal for all shareholders. Yes, it is a win deal for the largest shareholder, which is the government. Do watch out. This is one of the most important pieces of news to be tracking today. The next piece, the analytical piece, first Zydus Wellness struck a deal with Heinz, and then the Unilever GSK deal came in fast succession. While both sides got a clutch of brands, the battle experts say is to gain a bigger share in the malt health drink space. So who paid more for the brand? What else was thrown in the bucket? Agam Vakil is here with the details. Agam, good morning. What do you have for us?
Good morning, Neeraj. Well, it's interesting that this battle for malt-based drinks happened in quick succession in the recent times. So I'm going to start by taking a look at what both these companies, HUL as well as Zydus Wellness, have acquired, what they have, and they are looking to add in their portfolio. So I'm going to start off with HUL. As you can see, and we all know that they've had good, brands, well-known brands such as Brook Bond, Kisan, Close Up, Quality Walls, and what they will get now, what will also be a part of their brand list, will be Horlicks, Boost, Maltova, and Sensodyne. Of course, Viva will also be a part of that portfolio now. As you can see, the addition, as the management suggests, it could be complementary. When it comes to Zydus Wellness, while it has been in sugar-free, Everyuth Naturals, and Neutralite, what it is going to now add is Complan and Glucon-D. Well, some of the very well-known brands that we know about, that have been around for decades now, Nycil and, of course, Sampriti Ghee will also now be a part of the Zydus Wellness portfolio. But when you consider the valuations, there were just a bunch of factors that I wanted to point out as to why the valuations are what they are. So let's bring in your revenues for the last 2 years. Now, as you can see, for GSK Consumer, you can see that revenues have risen to a certain extent, not too much, as we all know that there has been a little bit of loosening of the malt-based drinks when it comes to volumes over the last couple of years. But GSK Consumer, on the whole, has seen a 2% CAGR over the last 2 years. On the other hand, for Heinz India, specifically, which gets about good 40% of its revenues from Complan, has actually seen a decline of around 2.9%, nearly 3% in CAGR over the last 2 years. That is one factor I want you guys to keep in mind at this point in time. Let's move on. Of course, as far as the margins are concerned, both give you around 19 to 20% margins. But this perhaps is the more important factor. This is the market share for Horlicks. That's 50%. All right. Another 26% from Boost. So this is 76% of the market share only with GSK Consumer. I know you may wonder, where is Bonvita in this situation? Well, your monitor indicates that about 14% of the market share is with Bonvita, which would be a part of perhaps, Okay, so pardon me, this is of course 26% the others, and that would be a part of this. And only 10% is from Complan. So you have to understand, and this gives you a picture of how Horlicks and Boost compares in terms of market share as compared to Complan and of course others. Now, this is the other factor that we may consider. So let's bring in the deal valuations then. Now, as you can see here, the deal size for GSK stands around 31,700 crores and Zydus Wellness at a little less than 4,600 crores. Sure, that's the deal size in terms of revenues too. But if you take the deal size to the turnover for GSK Unilever, that stands at 7.4 times, and Zydus Wellness at 4 times. This deal clearly is at a significant premium, and the reasons for it is, one, that revenues have risen over the last 2 years, and secondly, the colossal market share that GSK has over, well, anything as something like Complan, or for that matter, Cadbury's Bonvita. And that's possibly the reason why you've seen such a vast premium being paid for GSK as compared to Zydus Wellness. And that is something that I wanted to address and talk about, considering the malt-based drinks, because it's not every day that we talk about some of these factors.
Agam, I have a follow-up to this. I remember when this first inklings of the deal came out, and we were talking with PR Sanjay, I presume, when this news of the deal broke out. I think the common point that came out was that the market of the malt-based drinks was anyways coming off.
Right.
So to pay such a hefty premium at the current point of time when the market size may be coming off, what could the rationale be? What are experts saying? Is it because the large market share dominance and the great distribution that HUL would have would enable it to up the game?
Right, so experts are of the opinion if there's anyone who can turn around the malt-based market, it is going to be HUL, because they have a well-oiled, large machinery in place, which has been in place for decades altogether. And it's not like the brands that they bought are very small. As you can see from the market share itself, there's anything that can be turned around, there's hope for that, well, it is going to be Horlicks and Boost, and I think that's what they are pegging their bets on right now. So.
Okay, well, Interesting. Let's wait and watch how it pays off. Though I think brokerages across the board, Agam, have said that they are very positive on this deal as well. It's EPS accretive and it could actually bring about synergies for HUL.
So of course, so EPS accretive, that is the key word here. And well, they are neutral to positive on the deal as a whole. So that certainly is a plus for HUL.
Very interesting. Thanks, Agam. Thanks for putting that into perspective. You might be wondering why we're talking about HUL almost every single day. Well, here's the reason, right? Just bring up HUL stock as well the last few days. This was more an analytical piece, but frankly important because if you look at what HUL has done, even in trade yesterday, it nudged the new life highs, the 1 month return of 13% for a stock which is trading northwards of 55 times. I tell you, it deserves a mention every single day. If HUL is doing well and if the deal is EPS accretive and earnings for HUL might go up, the long-awaited earnings recovery for the markets at large remains elusive. Analysts have had to downgrade earnings expectations for a majority of stocks this year, and a large number of them have been fairly sharp. But it's not all bad. There have been some upgrades as well. Sameet Sarkar joins us with the sharpest EPS downgrades and upgrades this year thus far. Sameet, good morning.
Good morning, Raj. So we have considered stocks that have been tracked by at least 10 analysts, and we get nearly 269 companies here. And of these 269 companies, nearly 168 of them, that is more than 60% of these companies, have seen a sharp EPS cut from the start of the year compared to what it was yesterday. Now, if you see, of these 168 companies, nearly 60% have seen a cut, and nearly 18 companies of those 168 companies have witnessed a cut of nearly 50% in its earnings per share for the financial year 2019. Now, among these 269 companies, IT sector was immune because that was the only sector that did not see any cut in its EPS, and that was because of rupee depreciation that we had seen in the first half, while the major cuts had come in for sectors like telecom, cement, and some hospital chain companies. There are other sectors also, but majority of these companies had seen a cut in their earnings per share. Now, among the companies that have seen the biggest cut, Airtel's EPS has turned negative. Analysts have turned negative on Airtel's EPS has turned negative for the financial year 2019 to negative 3.56 from a positive 7.44 in April 2018. Now, that is because of the continued pricing pressure in the Indian telecom market, which have weighed on the company's margin. For Healthcare Global, also analysts have seen a similar move. The EPS estimates has turned negative to 0.01, and that is because of the losses that the company has done in the first half of financial year 2019 because of foreign exchange losses and because of higher interest cost. Now, we also have Fortis Healthcare here, where the EPS cut has been close to 97% from the start of the year, and that is because of the losses that the company has reported because of a large one-offs in the first half of financial year 2019. Also because its two business segments, that is diagnostic and the hospital chain business, have not seen such a good growth, and also analysts have adjusted their EPS for the planned fund infusion that the company will be doing. Now, Tata Communications saw a cut of nearly 85% for its EPS, but that is because of the subdued performance in its data segment and also because of losses in its growth and innovative service, which led to this EPS cut. Now, Interglobe Aviation, now that saw a cut of nearly 84%, and that is because of higher fuel cost, weaker rupee, and because of lower ticket prices, which led to huge losses in the first half, because of which the company's EPS was cut to around 11.93 rupees for the financial year 2019. Now, we also have a bunch of cement companies that have sent large EPS cuts for the financial year 2019. Orient Cement, Dalmia Bharat, India Cement, JK Lakshmi Cement. Now, all these companies have seen an EPS cut of more than 50%. In fact, Orient Cement's EPS cut has been nearly 76% compared to what it was at the start of the year. Now, that is because of lower cement prices. That is no improvement that has been seen in the cement prices, and because of higher cost in the first half of financial year 2019. Now, if you see on the upgrade side, not much here. Well, we'll start off with DLF. Now, that has seen an upgrade of nearly 153% to its EPS from the start of the year, and that is because of more than expected revenue and net profit, but that is because the company adopted a new accounting standard, that is Ind AS 115, and that is because why analysts had to upgrade its EPS. We have a couple of steel companies, that is Steel Authority of India and JSW Steel, and that is because of higher steel prices that were there in the first half of financial year 2019. Now, Nalco saw an EPS upgrade of nearly 49% from the start of the year. That is because it's alumina segment. Now, that outperformed on the back of higher volumes and higher prices, and because of which analysts upgraded Nalco's EPS. Lastly, we have Dish TV, where an EPS upgrade of nearly 40% was seen, and that was because of an uptick seen in its average revenue per user in the first half of financial year 2019, and because of realization of the merger synergies with Videocon D2H, analysts upgraded Dish TV's EPS.
Well, that's very interesting. Not too many upgrades, a lot of downgrades. Sameet, quite astounding to see the quantum of EPS cuts for a bunch of companies. Tata Communications has not been the best performing stock, but the size of the EPS downgrade has been fairly large. And the other interesting bit, Sameet, was that for the metal companies, while there are earnings upgrades, the stocks, because of the cycle turning around, have just been pummeled out of shape, a SAIL and Alco, etc.
Yeah, if you see, it was actually for the first half where they saw a good earnings report because of higher prices and higher volumes. But post that, the prices have come off, and that's the reason we are seeing all the stocks declining right now.
Yeah, so it's an interesting conundrum for an investor into SAIL or an Alco or some of the others, because the first half performance certainly means that the year-end performance on the EPS front will also be good, but the cycle seems to have turned just a little bit. So with very interesting data. Thanks so much for putting that into perspective. Well, there you know about the earnings, the upgrades and the downgrades, and that brings us to the end of First Word today. But a lot more lined up on Indian Open. We discussed the slowing demand for commercial vehicles with Gopal Mahadevan of Ashok Leyland. Talk about the implications of the new lending framework with SBI Managing Director PK Gupta. That's a very important conversation. And of course, talk about the OPEC meet and market conversations as well. And after this break, a full tilt towards the day's trade.
Celebrating 100 years of Smile, Services, Assurance, Excellence commitment. Building beneficial relations with customers and stakeholders. Union Bank of India celebrates 100 years. Thank you for your support.
RP Sanjeev Goenka Group, growing legacies.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate, and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
Welcome back. You're watching Indian Open right here on Bloomberg Queen. Today is the day where you're seeing red across the screen within the Asian market region. So you have the Nikkei 225 down 1.8%, and this is the second straight day of big losses coming in within the pack. Shanghai is down more than 1%, and Hang Seng now loses 2.5%. The start off and the look from the SGX Nifty's trade right now is that we may see a gap down opening. We most likely will see a gap down opening at down almost 1% for the SGX, 10,744 after losing in yesterday's trade by almost 1% as well. So we're not being able to hold on to those levels of 10,800 even for the Nifty 50. But whether or not the long unwinding is what led to the Nifty collapsing the way it did yesterday, or there were short build-ups in the system. Let's find out from Agam Vakil, who's joining in right now. Agam, good morning.
Good morning, Devi. Now, well, we didn't really see too much yesterday either, despite the fact that we did have a lot of events lined up. And as you can see on your screen now, this open interest have just increased by around 1.3% for the Nifty futures. It's a different picture for the Nifty bank futures, considering an accumulation in open interest towards fresh shorts, OI up nearly 5%. India volatility index, as one might expect, did advance too by around 1.5% to around 18.4. Coming down to your open interest distribution, nothing much has changed. We still looking at the 10,500 put with the max open interest. Changes in open interest were seen around the 11,000 put, where we saw unwinding, and 11,100 calls, where there was some more addition coming through. The Nifty put call ratio came off too at around 1.63. It was the same for the bank Nifty put call ratio at around 0.75. And in terms of stocks, Sun Pharma saw a lot of shorts building up. We also saw a lot of weakness in Bharat Forge, which fell on account of weakness in its US truck sales and accumulation towards shorts there as well. There was weakness in Dish TV, which also declined in trade. And we also saw some shorts build up in M&M, considering weakness in the auto sector as a whole. So, a considerable amount of weakness in the broader markets, and as per the indications of the SGX Nifty, likely to continue at least as far as the opening goes.
All right, Agam, thanks very much for that. That's the futures and options wrap out from yesterday's session. So a minor short build-up is what we saw on the Nifty as well as the Bank Nifty. Well, talking about banks then, and bankers forewarn of some short-term pain when the new loan pricing regime comes into effect from next fiscal. But they accept that this will lead to greater transparency. Let's talk about how the street is pricing in the development with Siddharth, Purohit of SMC Institutional Equities. He's joining us on the phone line right now. Siddharth, while obviously there will be some short-term pain, the longer-term benefits in terms of interest rate transparency is something that is keeping the sector particularly excited.
Good morning. Hi. So, see, the new formula by RBI says that all these floating rate loans for retail and SME has to be benchmarked to some rate, right? So over here, many external benchmark has been kind of indicated, whether it is repo rate, 90 days, 91 days T-bills or 180 days T-bills. So we don't know exactly which one the banks will take. Now, just to understand, most of the retail loans, if you look at either it is home loans or it is auto loans. So normally the auto loans are by and large fixed. So only the home loans part gets impacted for the bank. But over here it is clearly mentioned that, banks will have the option to choose spread, right? It only cannot be changed without any change in the rating profile of the borrower. So it really doesn't get impacted too much as far as the margins of the bank is concerned. What it does is that, basically the compliance or maybe the asset liability committee will have to work more as to how much to borrow, at what rate to borrow and what rate to lend. So it really brings more transparency and a little bit of compliance cost will go up. But it will not materially impact the earnings profile of banks because of this. So it is just a transition phase, I would say. But as far as earnings is concerned for banks, it will not impact too much, to my understanding.
Sure. So in the short term, it may just be a little bit more challenging in terms of interest rate management by banks, not so much so in terms of a material impact on the earnings profile of any of these banks. But Siddharth, one of the issues in the financial ecosystem has been that the real users' benchmark are different from the financial sector's benchmarks. Does this help them come on the same platform?
See, right now what happens, let's say even as a corporate lenders are much aware or much educated. But when it comes to the retail one, what I've used to happen is that now it used to be based on the MCLR, right? But the retail individual normally do not understand how an MCLR is calculated. They only know that this is my rate. But now over here, at least while the loan is getting disbursed and retail individual will have the knowledge that this is the rate I am getting charged, and based on this trade will be applicable to me, and this is the reset clause. And one more thing, what I understand, without looking at the guidelines, because the guidelines is yet to come, is that there might be more frequency of reset, because right now the reset clause is there, but the frequency of reset is not that high. So possibly it should benefit retail home loan borrowers going ahead, because there might be more frequency of reset going ahead.
Okay. Siddharth, one question from my end. If there is something on which there is a lack of clarity right now and you would want to understand from a banker, what would that be?
See, what that rate will be, on what benchmark it will be fixed on, whether it is on repo rate, whether on T-bills, 91 days or 180 days. Because the repo rate doesn't get changed every now and then, as you see. But T-bills are certainly tradable and it fluctuates actually, on a daily basis. So how banks will really manage their ALM, because it's not that easy to, because you have to manage your ALM and then lend accordingly. Otherwise, you will take a hit on the margin. So it is challenging on the bank's part to really manage their liability profile. So that is what I think banks will have to, tell us. And probably banks also will also be able to give a clarity once the final guidelines come. But my own understanding is that it really doesn't change the way banks work materially. But it does help retail lenders to large extent to get a clarity on the lending rates.
Okay. Good having you, Siddharth. Thanks so much for taking the time out and joining us early morning.
Thank you.
That's the view from Siddharth Purohit of SMC. Well, let's welcome our fundamental guest on the show, Parthiv Shah, Director at TRACOM Stock Brokers, joins us on the show now. Parthiv, good having you. Thanks so much for joining in. Much as crude prices stay benign and much as the bond yields come off quite sharply, the global scenario has changed materially. Pain on the screen. You would hold on to buying right now, or would you selectively start deploying money right now?
Good morning, Neeraj. Neeraj, I think overall macro setup, I think first let me talk about the US bond market as well. I think they've touched 2.90, and that was one fear that a lot of emerging markets like that of India had, that they were crossing 3.20% zone. And I think with that, there was a lot of fear about more, I think, FPI selling out from our markets. But all of a sudden that has changed thanks to Fed Powell's commentary. And that's indeed very heartening for an emerging market like India. And that's the key reason why in the last few many sessions we have seen the global money again come back into emerging markets, and that too into India as well. So that is something very good in terms of the setup, not only here, but domestically also. Probably yesterday the bond markets gave a huge thumbs up to the RBI policy, irrespective of the fact that it was like a status quo. But more importantly, the inflation trajectory that we are going to have. And I think despite the fact that the non-food and non-oil inflation is showing signs of spiking, which according to me is not at all a bad problem to have. I think it will help the industry and it will help the earnings recovery cycle that we are currently finding it challenging to be. So overall, I think the global and the domestic macro setup is extremely good. And I think thanks to the GSEC yields cooling off from very high levels of 8.30 to now levels of 7.44, and a lot of economists talking about this even being at 7.20, 7.30 in some time to come, which is extremely good setup for a lot of banks and overall economy. And more heartening was to know the composite PMI data, which did show, and it is a lead indicator, which did show good improvement after a very, very long time. So overall, my sense is the setup is good. The market certainly has different kinds of pockets, some very richly valued even right now, and some very nicely valued. So one will have to cherry pick the right portfolio construction, and any sort of volatility coming out of from the election results should be used to most advantage to construct a nice portfolio or to restructure any portfolio.
Parthiv, a bunch of newsmakers today. Yesterday news coming out that the cabinet may give clarity on the, or rather clear the PFC purchase of REC. What would this do to PFC as a company? It's not the best use of cash, I presume.
Yes, absolutely. I think one of the biggest beneficiary of any such transaction, which was inverse some time ago, is going to be the government of India. So helps the government of India's balance sheet, which is always good eventually. But yes, Neeraj, to be very honest, never ever have been a big fan of most of the PSU companies, and especially PSU lenders, keeping aside the PSU banks, but especially any sort of public sector enterprise which is into the business of NBFC, and that too into such verticals of lending to the discoms. So the key question mark arises, why not many of the banks or why not many of the other kind of NBFCs are venturing into this particular lending model? Obviously because it's very risky, and that's why the onus goes to many of the government-run NBFCs. No doubt, I think in terms of so far, I think the return ratios have been decent, but my sense is despite any such huge merger, which will certainly help to improve the credit profile, but again, I think there could be a sense of complacency in terms of their risk-taking ability, which we have seen in the past, that there have been a lot of slippages, there have been a lot of question marks in terms of their lending practices, and I think generally all these skeletons come out at a later stage, and probably that's the key reason why the markets value these companies a lot below their book value. So despite being decent dividend yield stocks, we have seen the dividend yields vanish in many of the PSU banks when a lot of trouble takes place, and probably the sense is that the discoms have not fully recovered. So I think I would definitely avoid any such kind of buy into such stocks, irrespective of the transaction news or the merger news that has been talked about.
Yeah, I mean, I was just wondering if there's some more downside to these names if once we have clarity out here. But yeah, that Parthiv's point is well taken out there. Well, lots more to talk about with Parthiv, but first go across to our research team to try and talk about all the key newsmakers in the session today. And, well, brokerage verdict on not just specific stocks, but also on the RBI moves yesterday and what are the key standout points there. So let's talk about all of those with our research team out here. Gentlemen, all three of you, good morning. Sameet, let's start with the stocks in news first.
Well, I will start off with Lemon Tree, where the company has opened a new hotel in Pune with a total room capacity of close to 201 rooms. Now, with this hotel, the company now operates nearly 52 hotels across 31 cities in India. The second stock that would have been focused would be Deepak Nitrite, where if you see the phenol prices have fallen nearly 27%, while acetone prices have fallen nearly 17% since the company started commercial production of its new phenol and acetone plant. So this stock would be in focus as the prices of its key products have been falling. Third stock that would be in focus would be Power Grid Corporation, where the company has received or has been declared as a successful bidder to build two transmission systems of 660 megawatt each for the thermal power project and to construct a substation of 400 kilowatts in Uttar Pradesh. The fourth stock that will be in focus would be Sagar Cements. Now, there are a couple of developments here. The company will be investing close to 258 crore rupees to build a 1 MTPA cement plant and 1.5 MTPA of a grinding unit. Now, they will be investing close to 150 crore rupees for the cement plant and close to 108 crore rupees for the grinding unit. Now, the company expects both of these plans to complete by March 2021, and to fund these investments, the company will also issue a convertible warrants worth 225 crore rupees. Now, a couple of newspaper reports that is interesting in today, where Business Standard reported that the promoters of Jet Airways, now they are close to strike a deal with the lenders which are led by SBI. Now, lenders may also consider converting part of that debt into equity, so that stock will be in focus. Now, as of September 2018, the company had a total debt of more than 8,200 crore rupees. Lastly, Mindtree, where Mint has reported that key large investors in Mindtree are looking to sell stake, where a private equity firm, that is KKR, might be interested to buy this stake. Now, these large investors include VG Siddharth and other coffee enterprises, companies which own close to 26% stake in the company.
Okay, we'll watch out for these names. Mindtree could be interesting. Also watch out for Deepak Nitrite, phenol prices cracking materially. Since we're on the topic of stocks, let's talk about brokerage's reactions on a couple of specific names.
Sure, Neeraj, I have two on my radar. We have JP Morgan on Aurobindo Pharma. I'm going to start off with that one because they maintain their overweight and they have hiked the price target to 940 from 835. They suggest that they are building on core business growth through recent acquisitions, and Auro's execution should provide comfort in the Sandoz deal. That's the big takeaway here. Sandoz deal is unlikely to be ROIC dilutive, and we are likely to see good growth coming in there. Moving on to Macquarie on Siemens, they have upgraded the company to outperform from underperform, and they've naturally hiked the price target to around 1,128 from 811. They say the business mix steadily moving towards short cycle product business. They also expect margins recovery to continue, which would drive 13% earnings CAGR over FY18 through 21. And they value Siemens at a 10% premium to Cummins on the business diversification and and large opportunity size. So 2 positive calls coming in from brokerages.
Okay, we'll watch out for these names as well. Thanks a lot for that, Agam. Brokerage's verdict on RBI.
Yeah,
Anything
so a lot of them came out, but I think the common consensus is that it will be on hold for the next few quarters, and only post-election there will be something. So Axis Capital says that RBI has painted up a best possible scenario. Robust growth and moderate inflation is something that they say. Rate hikes are off the table for the next 12 months, and they see scope for market interest rates to correct a bit more. Citi is saying they expect the RBI to stay on hold long now for till clarity emerges on inflation, and they expect the CPI forecast stance to change in the April policy. They remain bullish on Indian bonds, and they believe that the 10-year bond yield may drift below the 7.2% level. Nomura is saying they expect a formal change only in early 2019, and then there will be a long pause. They believe that the prospects are more accommodative. The RBI policy are positive for the rupee, and they prepare for a long hibernation while with rising rate cuts possibility. HSBC says that the tone of inflation sounded more neutral than hawkish. They expect the RBI to be on hold for the near future, but post the elections they see a 25 basis point hike that will come in. Phillip Capital says that the oil price volatility is the key risk to RBI CPI estimates, and they expect the RBI to stay on hold for the rest of FY19, assuming that oil prices stay stable. And MK says they expect a status quo on policy and rates for the next 3 or 4 months. But the banking sector measures do not provide much respite for the sector, according to MK.
Well, interesting thoughts there. Thanks a lot, all of you, for joining in and giving us those perspectives. Parthiv, 2 or 3 names that stand out. Do you track Deepak Nitrite? Phenol prices have cracked quite significantly over the last 1 month.
Certainly, I think, generally, I think it's not fair to see only the phenol prices crack, which have certainly cracked by 27%, does not bode well. But generally, the best idea is to see the cracks, and especially the prices of key raw materials, which is benzene and propylene. Both of that, I think, in the past, if you were to see, what had happened was the phenol prices had gone up a lot, and I think we had seen slight decline in the benzene and the propylene prices. So the spreads were extremely rich and probably unsustainable. And now what we've seen is like crude has corrected by 30%. Phenol has corrected, and probably it will be important to see how the benzene and propylene prices have reacted. So I think still probably for a company like Deepak Nitrite, which has done a state-of-art capex, and it's extremely important for them to have a sustainable price of phenol and acetone, so that I think the return on their invested capital is justified. And probably the break-even point in terms of their kind of plant happens at somewhere around spreads of around $400. So I think they're still a little comfortable, but one will have to monitor the situation. If crude were to further collapse, I think probably it will not bode well, and we could see some sort of derating in the stock price of Deepak Nitrite. So that's a key problem with many of such companies which are highly dependent on crude as a factor, and a lot of raw material moving here and there, which could impact their capex.
Okay.
What substitute? I think the trajectory is good for Deepak Nitrite.
All right, that's, however, the pricing action over the last 1 month has not been all that encouraging. But let's talk about the stock and a lot more with our technical experts who are joining in right now. We've got Sameet, Chief Technical Analyst of Technicals and Derivatives at Angel Broking, who's joining us. Along with him, Nooresh Mirani, Head of Technical Research at AMSEC, also is here with us on the show. Gentlemen, thanks very much for taking out the time. I'm going to start off with you, Nooresh. Yesterday's session, we broke 10,800 on the downside. Does the framework look a little more fragile this time around on the index? We're looking at global markets petering off and that having its own negative implication here for the Nifty 50.
Technically, we are looking towards this as a bounce back. So the bounce back was over somewhere closer to 10,900. And maybe now we test 10,600. And if that goes off, the last bottom at 10,480, 450. So overall, that's the trend in the near term. We can test those levels in the next few days.
Okay. Would you trade the index in any way, Nooresh?
So because of the possible gap down, the risk reward shifts a bit lower. So any bounce backs in the day back to 10,750 on the Nifty could be used as a short position and a stop loss at 10,800.
Okay. I believe you've got a call on the Bank Nifty as well.
Similarly, Bank Nifty has also seen a reversal from after the bounce, where we expect a zone of 26,000 odd on the near term, and if that goes up, we are looking at 25,400. any bounce backs during the day towards 26,450 would be a short trade with a stop loss at 26,550.
Okay, we'll talk about Nooresh's stock ideas as well in just a few minutes, but let's take Sameet's calls on the index. Sameet, what are you doing with the Nifty and Bank Nifty?
Hi, last Thursday we saw Nifty giving a breakout from its recent hurdle of 10,750, 10,800 with an upside gap. And in last 4 to 5 days, we inched towards 11,000 mark, and since last 3 days, market has been correcting. And with today's gap down opening, we would be back to those levels to previous breakout point. So it would be very crucial for Nifty to remain about 10,700, 10,650 in order to see some kind of more strength and move towards 11,000. So today's session would be quite crucial, and we'll be closely tracking how Nifty behaves around 10,700, 10,650. If it breaks, sustains below that, then it would lead to a confirmation of a rising wedge pattern, and in that case we could see extended correction. So as of now, we believe that today's close would be quite crucial. If it closes below 10,700, 650 convincingly, then we are heading for lower levels, or else if it manages to defend those levels, then again we can come back to 10,900, 11,000 levels.
Okay, let's talk about some of your stock ideas then, and Sameet, I'll start off with you. You've got a sell call on a Sun TV and a buy on Britannia.
Yes, in such kind of market you should have position on both sides. So Britannia is the one stock. Recently we have seen decent recovery from lower levels. Couple of days back there was a breakout from recent hurdle, and in last couple of days the stock has retested those breakout point. So as of now we would interpret this as a good buying opportunity. It's a pullback, and from here on we could see Britannia heading towards 32.80. It can be bought with a small stop loss of 3038. And Sun TV, which has been clearly underperforming of late, we were of the opinion that the stock would give some kind of bounce back, but yesterday eventually it closed below its important support level. So from here on we could see extended correction wherein the stock can head towards 556. One can go short with a stop loss of 586.
Okay, those are some of Sameet's calls. What about you, Nooresh, on your stock ideas?
So the first trade is a short on Page Industries, wherein looking towards a target price of 23,500 and lower, and a stop loss at 25,500. The stock has broken down, is about to break down the last couple of bottoms around 24,900, 25,000. So expect a quick crack on this one. And the other one is a buy on HCL Tech, which gave a triangular breakout yesterday when it closed about the recent weekly highs about 1,045, 1,050. Expecting a move towards 1,100 plus in this stock. And a stop loss at 1,020.
That's interesting. Today, the CLSA is giving out a note on HCL Tech.
Cheapest IT stock in that league of big IT stocks as well in valuations.
Yeah, on valuations and the fact that
deal orders.
Yeah, well, yeah. So that's I don't know. I mean, that's not necessarily the reason why the stock should do well, but arguably the valuations are not the best for HCL Tech compared to some of the others. Wipro is at 52-week highs or life highs, as the case may be. HCL Tech isn't quite doing that, and still giving fairly decent numbers and talking about double-digit growth even in this year, even though it's a lower end of the double-digit curve. But could be an interesting one to monitor today.
Yep.
Okay, so watch out for HCL Technologies in the session. I think a couple of other names that we need to watch out for. Parthiv, I want to come to you on Bharat Forge. Now, Class 8 truck order sales, and frankly, probably that entire community, right? Jamna Auto has been correcting for the last few days. There were some individual concerns which are probably unfounded but raised. But that notwithstanding, the CV order pullback and the impact on companies like Jamna Auto, and then the Class 8 truck sales come off in the US, the impact on companies like Bharat Forge, Ramkrishna Forgings. What do you do with these set of stocks?
See, unfortunately, not only Class 8 trucks, also the MHCV segment, I think they're showing a clear-cut slowdown in the domestic market. And this particular component of business, which is relatively decent in terms of the margins also for a company like Bharat Forge, forms almost 44% of the standalone revenue. And another problem, Neeraj, this company is facing is also the non-automotive business, where a lot of that business comes from the oil and hydrocarbon segment. So I think even that is feeling the pain in terms of the oil crashing down. So probably that's the key reason why the markets have derated a stock like Bharat Forge.
You reckon there is more?
But generally, I think if one...
No, please continue.
Yeah, so I think my sense is generally the best time to own these stocks is when the valuation multiples have contracted, and you do have to give credit to a management like that of Bharat Forge, which have mitigated the business extremely well. And I think this could be a temporary slowdown. It's a cyclical play. So for the 5 to 10% downside based on such news, and I think I would be a buyer in Bharat Forge for the next 2 to 3 years.
Okay, interesting. Maybe now the other very interesting thing that we should monitor is Sun Pharma, and if you can pull up those charts, to just showing a couple of very interesting parameters. Yesterday, Darshan was saying that the first time that the price earnings multiple of Sun Pharma is below the price earnings multiples of Cipla, Dr. Reddy's, and Lupin, so the larger pharma companies. It's the cheapest P multiple for Sun Pharma in over 6 months. And this price erosion is happening on very high volumes. So I think the cash market volumes on a weekly basis are the highest in over 3 years for Sun Pharma. So delivery-based selling and fair bit of short positions which are not showing any signs of unwinding. I mean, you track FNOs better, but I'm just saying if it's just a trading move, then with the price movement coming off, maybe some bit of open interest should cool off. Yesterday, the OI was not showing any signs of a pullback. So the shorts are still there despite the fact that they are well and truly in the money. Nobody's covering those profits.
Well, it looks like Mr. Dilip Sanghvi's clarifications have not been helpful to the stock price at least. So 415 after some time now for Sun Pharma. But does that present a trading opportunity, Sameet, on Sun Pharma?
See, clearly in last 15 days the stock has corrected significantly. The first trading point for this particular counter started around 540, 545 when it broke down its important support level, and since then we are seeing series of low top lower bottom formation. At this level, it would be very difficult considering the risk to reward ratio. Direction wise, yes, this stock is likely to see sub 400 levels, and from here on we won't be surprised to see this stock getting towards 380, 370. But minor bounce back probably toward 430, 435 would make it a good risk to reward ratio.
Parthiv, what would you do with Sun Pharma or Sun Pharma Advanced Research as well? Both of those companies have just come off meaningfully.
I think Neeraj, extremely difficult situation, and what has happened is that all the scope about in terms of the growth of the new molecules for FY20 has gone down the drain. I think that was the only hope that shareholders of Sun Pharma had, that probably come next year, I think we would see fruits of all the complex molecules that they had been investing into. But any talk about things of corporate governance, and I think it's really, shocking that such skeletons have come out after such a long time, because I think this is not a stock which has been thinly tracked. I think it's been tracked by global, analysts, and everyone would have checked the balance sheet annual reports for so many years. And this coming out now, and probably the management also hinting at that, yes, they did lapse in terms of some of their best corporate governance practices, which they will improve, which is an indirect admission of the wrongs. And still there are certain question marks and some of the key concerns. Probably, I think we have seen many institutes who, on any sort of news about corporate governance, would not care about the upcoming fundamentals, but would sell the stock lock, stock and barrel, and then probably later on ask the question. So I think it's a very difficult situation, and very hard to give a call for someone owning this stock. But new entry, I think, now becomes very, very difficult. At least till the dust settles, or now the only hope being that the results turn around in Q3, Q4, which is again a wishful thinking. But such a de-rating was never expected in a stock like Sun Pharma, and I think difficult times for the company and the management.
Nooresh, within the pharma space, the other one being Lupin, from highs of about 960, 970, the stock currently trading, making its approach slowly but steadily, currently at about 860 odd. Would there be some upside left in Lupin?
So Lupin for the last couple of months has been a range of 820, 830 on the downside, and somewhere closer to 900, 910 on the upside. So this is the range. If we break out of this range, we could see a 10% move. So as of now, we are right in the middle of that range. So we would wait out for a specific trigger beyond this range to make a fresh view.
The last 1 month, most of these private sector banks have done relatively okay for themselves. And amongst the larger names, an HDFC Bank, the HDFC twins in particular, have shown some amount of strength, about 8% higher for an HDFC Bank at 2100 and HDFC Limited at 1973. Quickly, Sameet, if you were to take a trade on any of these two?
No, HDFC Bank certainly looks good and it has already given decent move in last 3 weeks. But if I have to take any position on this counter, I would wait for further declines towards its important support levels of 2060 to 2040. In that case, it becomes a good bet for an immediate target of somewhere around 2140, 2160.
Okay, got that. We've got about 40 seconds left to go for market pre-open, and no points for guessing which direction that's going to be in. We've got the SGX Nifty slipping a little bit more now. Last time we took a check at the start of the show, was down closer to 0.8%. That's worsened now, and so is the case for the rest of the Asian market pack. Nikkei 225, Shanghai Hang Seng now bleeding a little bit more. SGX Nifty is down a whole percent at 10,729 right now. So yesterday we didn't manage to hold fort around 10,800, took a beating and came shut shop below that, and this morning's trade will probably be making our approach towards 10,700. That's the market pre-open for you. Down about 0.8%, almost 1% right now for the Nifty 50. Sensex slightly more divergent, but these are just the initial price moves that are coming in. Wait for a few minutes for these to cool off. A few stocks then and start, taking individual counters thereof. Wipro is showing you a 9% cut this morning. Okay, it's become 6% now. Kotak Mahindra Bank, Sun Pharma, Bharti Infratel are some of your bigger losers. Now JSW Steel is down 1%, HPCL is down 1%. Then you got the likes of ICICI Bank down 1%. Yes Bank 171 on the stock. The likes of Hero MotoCorp, Grasim 0.75% given up. HUL now at 1835, and Tech Mahindra looks a little bit more weak, down about 0.75%. Amongst the gainers, Adani Ports is at 384 now. You've got the likes of a Sun Pharma, Dr. Reddy's Labs, then you've got an HDFC Bank, Kotak Mahindra Bank, L&T, and NTPC as some of your gainers, but the quantum of gains fairly subdued, not much happening out there. More weakness in the currency. In terms of the rupee versus the dollar, we're now at 70.83. So that has worsened a bit by around 40 odd paise this morning.
Interesting. Pull up Sun Pharma Advanced Research, again showing a very volatile pre-open rate. May not be as strong a downtick on open, but let's wait and watch. Actually, just while we are at it, let's just get Sun Pharma as well once again. Devina would have marked it, but just mark that once again. That is not showing as much of a crack. I would presume then, therefore, that Spark may not really show a 20% downtick. Let's wait and watch what happens there. 8K miles, yet another day of a lower circuit. Remember, we were talking about this yesterday. Stocks which move up on circuit to circuit become very difficult to own or trade. And I hope people didn't get caught on the wrong foot. Again, these rates may change, but looks like Spark or other 8K miles will have a start, which could be marginally in the red. What else? Are specific pockets of strength there. Siemens, double upgrade by Macquarie, and let's see if that stock is reacting positively. No, not quite. Lying slightly flat in trade. Yesterday's top losers, the likes of Kesoram, which got sold off once the demerger was announced. And let's see if there's more weakness here. So after a 12-13% downtake, another couple of percentage points downtake for a Kesoram. Bharat Forge, which corrected quite a bit as well. Has that gone off a bit in today's session? Well, maybe start off slightly lower in trade. We don't have too many big movers. Cafe Coffee Day and Mindtree haven't quite moved around. CCD about 1.5% higher. Mindtree should come up on your screen. Mint reported that key investors might sell stake in the counter, but no, not quite reacting to that piece of news. So quite as she goes at the broader end of the spectrum, some key losers continuing, but not too many losers as well in the session right now, which is not a bad sign. At least the top loser is 8K miles, which is down only about 5% on the Nifty 500. These rates may change, but for now, the broader markets seem a bit more okay. The large caps all over the place. Let's see what happens during the course of the day.
Right. Parthiv, any particular stock that you're closely looking at right now that presents an opportunity according to you?
So, Devin, I think I would wait for a better entry point, but still, I think if we were to discuss any themes I think paints as a sector is looking extremely good to me. And not only I think the paints in the industrial segment, but more importantly the decorative segment. And I was listening to the commentary that was passed on by the management of Berger Paints. I think again, after Asian Paints, this is the second best favorite stock, but I think this stock will do extremely well, not only because of all the capex that they've done or future plans that they have, and also some very good joint ventures that they've had. This company has taken almost a 3% price hike, and probably the management didn't seem to be in a mood to now reduce the prices because a lot of key raw materials would now decline in the next quarter. So what we are expecting is not only decent volume growth, but also margin expansion, which probably in the last few quarters we were seeing an aberration. So I think setup is extremely good, and I think this is the second largest paint company. If I have to look into the market cap delta between that of Asian Paints versus Berger Paints, it's still huge. So I think long way to go for a player like Berger Paints. And paints as a segment, I think over the next 5 to 7 years, my sense is I won't be surprised if such a quality stock were to grow in terms of its volumes by almost double digits and also have very healthy set of margins. So I don't see a reason why from here over the next 5-7 years this won't be a multi-bagger. So Berger Paints would be the stock that I would pick in such a market condition.
Okay, I'll come to our technical experts in just a bit, but one more bit of news that I need your comment on, Parthiv, is the earlier proposal of getting REC to buy into PFC now flips over, where the government is proposing PFC to buy into REC. Have you managed to get your hands on some details regarding this particular deal that happens, and how does this play out for both PFC and REC?
See, frankly, the ballpark number that has been spelled out is around 15,000 crore, which is what the government garners. Again, my biggest issue is that I think last quarter what we saw in terms of REC's reporting 4% names. Again, a big question mark is whether it's going to be sustainable in H2 or not, and I really doubt that. And also, I think the combined entity, and probably another logic of having a combined entity, besides all the good talks about a better credit profile, is also trying to overlap on a lot of their lending assets which are in trouble. And I think, yes, we always talk about a lot of cases which are there into NCLT, but I think their cases are best solved when the money comes back and the recovery has taken place. So I think it's more like a move favoring the government rather than the shareholders of both the companies. And if I think both the companies independently were not doing great in terms of delivering the best return ratios, and again I think they are companies which don't have a lot of flexibility in lending to other verticals, so why be confined in terms of owning a stock or a combined entity stock which are lending only to a select set of entities like that of discoms and some power projects. So never a big fan of such a business model. So I think my sense is investors are better off avoiding such a structure, and even the deal does not bring any sort of hope for existing shareholders of these companies.
Okay, that is on a PFC and REC. On a Yes Bank, Nooresh, if you've been tracking the stock, it's not fallen to a great extent. I mean, still holding within that range of about 160, 175 in the last few days.
So technically, again, the last candle which it made around 145, 150 was a strong reversal candle. So till the time we hold above the highs of those days, which is closer to 165, 167, the trend remains positive.
Okay, 169 and counting. And on Sameet, on those two names we were discussing earlier, PFC and REC, what do the charts suggest? Can you take a trade?
No, it has become very difficult to take trade in such kind of names. Recently, we saw a good V-shaped recovery from lower levels in both these names, and again they started corrected. 3 days back, there was a sharp bump up seen in PFC, REC, but again yesterday we saw this, good bounce back getting sold into. So overall speaking, the volatility has risen in these names, and if you see the trend, previously has been clearly on the downside. So any bounce back in these stocks is likely to get sold into. So unless we see a breakout in PFC on a closing basis beyond 105, we would avoid getting into this counter.
And that seems a bit far-fetched if indeed that decision that the PT has reported yesterday about the cabinet clearance for PFC buying into REC comes about. That 105 level seems to be a bit distant, if I can put it loosely. Okay, what else? There is Kesoram, which has corrected over the last couple of sessions. Nooresh, might become difficult to kind of give an accurate call out here, but if you can, because it's had about a 59% uptick in the run-up to deal. Once the deal got announced yesterday, down 12% yesterday, down another 3% on pre-open session right now. What do the charts indicate?
So technically, we've seen a huge volume bump up right from the time when it hit a 20% circuit at around 60, 70. So, and post that we had a good consolidation between 75 to 80. So that could be a zone which could be till the time we hold about 75, 77. So it could be a risky buy around 80.
Okay. I'm asking you if the other question that I want to ask you, Nooresh, is on HUL. We're talking about a lot of losers. What about stocks which are gaining? Two large caps, HUL and Wipro, at highs, and HUL certainly piling on the gains. For somebody who went long earlier, is it prudent to take some money off the table looking at the market, or would you continue staying long in HUL?
So if you look at HUL, we would consider taking some money off because the rally right from 1500 levels has not seen much of a correction. So even if it has to go further, we can see a pause before a new trend emerges. So HUL would be a book at current levels at 1850, 1900 zones. And Wipro is something which could be very interesting once it starts sustaining above that 340 mark, because that would be almost be a 3 to 5 year high. So sustaining about 340, 45 would be a better way to look at it in momentum.
Okay. Chavan, stay on. Lots more to talk about. We'll get in opening thoughts from our technical experts as well, and some final thoughts from Parthiv. But just minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Government takes a U-turn in its PFC-REC plan. Now PFC may be asked to buy out REC. The earlier plan was for REC to buy PFC. Cabinet will today consider the new proposal, which may boost government's coffers by about 15,000 crore rupees.
These days, ask what's happening in China and you may find the risk. China phenol spot prices have seen a fall of 7% in the last 5 trading sessions. This puts Deepak Nitrite under the spotlight for trade today. The company just announced commencement of production at its mega plant for phenol.
Sagar Cements will also be in focus today. The board has said yes to a new greenfield project in Madhya Pradesh. The project will require an investment of 150 crore rupees.
Key Mindtree investors are looking to sell their stake according to a Mint report, and global private equity firm KKR may buy its way into the IT firm.
Here's a key brokerage call for you. Macquarie gives a double boost to Siemens, elevates the rating to outperform from underperform, and also hikes the target price to 1128 rupees per share.
Lastly, some bulk deals. Prime India Opportunity Fund has bought 2% stake in Inox Wind. Nomura was the seller.
Well, watch out. Inox Wind likely to start off about 3% lower. In fact, the pre-open rates as they have settled don't suggest any major gains for the large caps. If at all, select mid caps could be moving around. Yes Bank may start off about 2.5% lower, and SAIL may continue to grind lower at about 52. Parthiv, one question on SAIL. We were looking at the earnings estimates as well for SAIL and Analco. They've actually been revised upwards based on the first half earnings. Naturally, the second half earnings will be a lot weaker. But the stock has been decimated from highs of 96 earlier in the year to 52. Is it really looking at more downside because of the turn in the cycle, since you track commodities so closely?
Neeraj, one key data point for a company like SAIL I would like to share with you. I was checking out a chart of the operational efficiencies of steel companies not only in India but around the world. And India supposedly is one of the lowest cost producers of steel on an average as compared to many of the pockets in the world. And unfortunately, SAIL, despite having its own iron ore mines, despite having near monopolistic situation in some of its products that it sells to the government like railways, etc., I think the EBITDA by ton over so many period of years has been abysmally low. Probably it's one of the lowest in the world. Many of the companies which are just converters, not owning any iron ore mines, not owning coking coal mines, they are better off than SAIL in terms of its operational efficiencies. And always, I think time and again, historically, we have seen any government PSU giant like SAIL having any sort of capex plans, modernization plans. There are always cost overruns, there are always delays. And in a scenario like this, where prices were to correct even by 5-10%, we see that entire earnings get wiped off. So total clear-cut avoid SAIL would be. I would any day prefer a stock like Tata Steel, which is also at mouth-watering levels right now. And on further corrections of 10%, JSW Steel would become very attractive.
All right, got that. Any trading activity or trading play that's likely in this pocket, Nooresh, metals?
In metals, I would be looking at JSW Steel as a risky bet closer to 295 to 290 levels with a stop loss at 288 because that was the low in June, July roughly. So if it continues to hold above that, we could see a bounce back.
Okay. We've got a minute left to go for a market opening. The Nifty is just hovering around 10,700 right now. But let's get in some top calls from our technical experts right now. Nooresh, we'll start off with you for your top call of the day.
And that would be a buy on HCL Tech with a stop loss at 1025 and a target at 110 plus.
Okay. Sameet, what about your top call?
Yeah, despite a weak stock, I'll go with a buy on Britannia, trading around its important support levels, and hence we expect this stock heading towards 3280, go along with a stop loss of 3038.
Any auto pack, Sameet?
Sorry?
Auto pack.
See, within auto pack, it has become very difficult to take call right now, but Bajaj Auto is the one stock within two-wheeler space that has been clearly outperforming since last 1.5 week, and it looks quite positive. It is trading around its 200-day moving average, but recently there was a breakout, confirmation of high top, high bottom on daily chart. So minor pullback from current level around 27.20 would be a good buying opportunity.
Sameet, Nooresh, gentlemen, we leave it at that. Thanks so much for joining in today. But here's how the markets are starting off this Thursday morning. Well, weak, not as weak as the SGX Nifty was indicating, but weak nevertheless. Let's wait and watch if they slide further. The Nifty Bank about 200 points lower. So this is exactly in line with the world markets, to be honest. Asia has a deeper tick of red. Maybe we corrected in part in trade yesterday as well. Now, mid caps and the small cap should also come up on your screen, and let's see what's happening there. The mid cap index about 1% lower. The small cap index just about 1/3%. So, well, no alarm bells out there. At some point of time, we'll also mark what's happening to the yields too, once again, because they corrected quite strongly yesterday. But first, let's stick to the markets and get the heat map up on the screen, and let's see what's moving and what's not. So hardly any gainers. Sun Pharma bounces back. Well, that's news, all right, because after a lot of pain the last few days, it has a minor pullback. Let's see if this lasts or no, but hardly any gainers. This is very similar to how we started off trade yesterday. A very thin line of gainers, all of them less than 1%. What about the losers? OMCs and IOC in particular is down about 3%. JSW Steel, Tata Steel, Vedanta, I think that entire clutch of names look weak. And if indeed the trade tensions are the thing to go by because of the Huawei incident, you would probably believe some stress on the global growth, and therefore the sentimental impact on the commodity names will come about. Yes Bank slides a couple of percentage points, some weakness in Cipla as well, but just that one key thing, that aside of HCL Tech and Infosys and TCS marginally out there, we're not seeing the defensive buying come back in a meaningful way. Hardly any buying as of now, even though the index is just about 0.6%. Couple of pockets that I want to mark before I hand it over to Devina. Stocks which were very active in trade yesterday, and let's see what's happening to some of those in trade today. And then a couple of newsmakers that I just want to quickly mark. Firstly, Brokerage is upbeat on these two names, HCL Tech as well as Siemens. However, as I said, not a big reaction on any of the gainers in the session thus far. What about companies which were down and out in trade yesterday, the likes of Kesoram, Bharat Forge, etc.? Well, the start of week, Kesoram definitely starts off week. Bharat Forge about 1.5% lower. Sun Pharma Advanced Research in line with Sun Pharma just bounces back ever so slightly. And Deepak Nitrite, just one last thing that I want to mark. The crack in phenol prices, the stock continues going down. 237 now, 2.5% lower in trade. Devina, what are you spotting?
Start off with a few gainers then from the sugar space. You've got the likes of Balrampur Chini doing okay for itself. Along with that, Praj Industry stacks up with 2% gains. You've got the likes of a Jet Airways, which sees some amount of a bounce back, so 289 on Jet, that's up. Tata Coffee is moved up. You've got the likes of an Aegis Logistics, Welspun Corp, Welspun India, both of them up 0.5%. DV's Lab does okay for itself, and from the real estate pack, and HDIL and Unitech, both of them are fairly okay in terms of the kind of gains they're seeing this morning. Amongst the bigger losers, you've got the likes of Anal and FS Transport once again now at 13 rupees, that's down 5%. Inox Wind is down 2.5%. IOB moves lower. You've got the likes of First Source Solution, Century Ply, Cox & Kings, First Source Solutions 53, and some of the fertilizer names that are looking relatively weak this morning. KRBL also is down about 2% in trade. So all in all, the advanced decline ratio also at the start of trade is heavily tilted towards the bears. 867 stocks declining versus about 250 stocks in the green.
Okay. Well, so seems to be a tepid start. Let's see if it continues to worsen from here. Let's get in Chakri Lokapriya from TCG Asset Management joins us right now on the show. Chakri, good afternoon. Thanks so much for joining in.
Good morning.
Great you spending some time with us today. What's the sense, Chakri? A very sharp pullback from those 10,000 levels all the way to 10,900. Now some bit of jitters on the global front is starting to correct. Can this correction deepen?
You know, India also has elections coming up, rather election results coming up in the next couple of days, tomorrow. And so against this backdrop, there is bound to be a volatility downwards. So I think this is a time to stay on the sidelines, and because there is still some more confusion for it to settle down. But if you are a medium to long-term investor, I would actually start looking to buy at current levels.
Okay. Does this staying on the sidelines is the apt advice, Chakri? But just wondering, you know, we actually put it out yesterday as well. OPEC today, the election verdict tomorrow, or the exit polls tomorrow, and then the election verdict, then the Fed meet as well. Does this period come with a larger bias towards the downside? Even if you stay on the sidelines, do you reckon that accumulation could happen at lower levels as well, or do you believe that the market is primed up right now for staying at the current levels because of the growth factors, etc., etc.?
You know, it's a tale of two halves. If you look at the world, the US is still doing economically really good. Unemployment phenomenally at 40-year lows, consumer inflation very low. So it's highly unlikely that, so where some of the market participants talk about a recession coming in the US, which is highly unlikely. So against this backdrop, the concern is more whether domestic growth can pick up. So which means from an Indian perspective, the IT companies, the pharma, the export sectors, they will continue to do well, because, and you should use the opportunity if there's any weakness in these sectors to buy. On the other hand, the pure domestic names, there's still some more downside, and especially the infra and the utilities.
Okay, just from the looks of it now, once it's probably going to be the next quarter numbers is going to gain more importance now that quarter two is out of the way. But any pockets now that look, actually attractive from the point of view that you could see a turnaround? Because for one, auto as a pocket, if you were to see this quarter, wasn't all that great. Even volume numbers were a little bit more subdued. Do you see the cycle turning here?
If you look at both the short-term cycles of the last couple of years and slightly longer, over the 4-5 year cycles, the volumes are down for auto companies over the shorter term. So which means that, even if you look at longer term averages, today the consumer has slowed down for various reasons. And this can be a combination of higher insurance factors, higher interest rates, and uncertainty, and therefore waiting it out. So against this backdrop, seasonally, it's unlikely that the volumes will pick up for autos anytime soon. And if you look at their valuations and ROEs, they're trading at their historical 5-year, 7-year averages. So there is no real, what you call, support for the stock at the current levels from a valuation perspective. So I think volumes are unlikely to recover in the second half, and therefore the stocks at best will trade range with a downward bias.
What did you make of the RBI policy yesterday, and obviously what they mentioned with regards to benchmarking retail loans to global benchmarks, and how does that play out?
Two things. From RBI's last month to this month, oil is down 30% last time when they came to this time around, and they could have taken that into account and probably changed their stance to a neutral stance rather than maintaining the calibrated approach. What do you calibrate with oil down 30%? Which means inflation is, in RBI's own admission, is going to be 3% odd going forward in the second half. So which actually indicates that there is inflation is not a risk, therefore interest rates should not be a risk. And now this benchmarking thing, now you'll have different banks benchmarking to different benchmarks, and therefore from an analyst perspective, you would have to take that into account, whether one is taking a GSEC rate or somebody is taking a repo rate as their benchmark and putting a spread on top of that. So it is then adds a bit of apples and oranges comparisons, which seems to be the order of the day in terms of the new norms coming out. So it's just going to make analyst life a little bit more difficult going forward. But outside of that, I don't think any meaningful difference.
Interesting. Chakri, we have a lot of election data, and I'm sure we're going to be talking to you on the election verdict day as well. So maybe I'll save some of that for that day. And I want to stick to some key movers and shakers which could be impacted because of the global moves. The metal space, the Vedantas, JSW Steels, Tata Steels, ferrous, non-ferrous, etc. Everything is getting beaten down. Is this essentially the worries of the global GDP growth coming off and therefore commodity prices likely to cool off? Because the correction has been fairly steep.
Yeah, it's a combination of two things. If you look at Indian metal companies, all the names that you mentioned, JSW Steel, Tata Steel, Hindalco. Hindalco probably less so, but the other two companies have a far higher level of debt. So if you go fast forward into the future and commodities being a cyclical thing and they turn down, will their cost of servicing go up is the concern. And they're trading at probably in line with historical averages, so they're not exactly very cheap. So from that perspective, but I would still hold on because at 9-10 times PE, they're not expensive stocks at all. So it largely depends on whether the commodity cycle stays intact, which we think it will, at least for the next couple of years.
Okay.
We were having a look at some of the bigger IT names as well, and while some of them are trading at their peak valuations, I'm not getting into stocks, but just as an example, HCL Tech for that matter is relatively cheaply valued versus some of its peer with the same kind of growth potential, maybe slightly lower. So would you start to differentiate and start picking out those value buys where growth potentials are sanguine, but valuations compared to peers with not a very big difference in growth is way lower?
HCL Technologies and even Hexaware is a good example of how these companies, their ROEs have actually trended up in the last few years. And but the re-rating in the stocks has not happened. Now, HCL Tech, out of the large TCS, Wipro, TCS, ICA, Infosys, and the other big guys, is always treated as a poor cousin and given a lower multiple.
Always, yeah.
And so I think, and market has kind of ignored the improvement in its fundamental metrics. So against this backdrop, it is an inexpensive stock trading at about 11, 12 times, and earnings potential will maintain good 15% going into the next out. So I think it is a stock to buy, and so is a Hexaware or in the mid-cap space, a company like Cyient, which has corrected quite a lot last month but not recovered since.
Okay. Just wondering, Chakri, you scan a bunch of spaces in order to manage your portfolio management services. You guys, I think, recently got awarded as one of the best emerging PMSs as well, so congratulations on that. But
thank you.
When you look at that entire sphere, where is it that you feel that there is the best bang for the buck if somebody is willing to hold on for the next 3 years? It's not necessarily a 6-month argument. Elections will come, elections will go, other factors will go down, all will go up. But if you 3 years view, what's the best space to invest money in right now?
I still think it is the banks. And
what kind of banks?
Both the PSU banks as well as retail banks. And especially if you take an SBI today, it's trading at 0.9 times book. Union Bank is trading at half a time book. Canara Bank, example, trading at 0.4 times book. So are you telling me that 60% of its loans will be written off? Highly unlikely. So all these, some of it will be written back, in fact, if you give it a sufficiently long period of time. So if you, and that's on one hand, and second is, just when you say this retail versus corporate, if you take ICICI, Axis, even SBI for that matter, all these guys are increasing their percentage of their total loan book in lending to retail, car loans, that kind of stuff. So which means that line is going to blur between a pure corporate bank who has a greater bias, which is largely the PSU banks. But within the private banks with corporate and retail, that line will blur in a couple of years out. They'll have both retail as well as corporate lending as their overall book. So against that, all their valuations will kind of coincide, converge. So against that backdrop, I think a number of banks will move up the curve. So they'll still make far more returns than the index if you hold it.
All right. The other part, while you're speaking about banks, is do you see the challenges for NBFCs persisting?
NBFCs, yeah, the liquidity needs to be provided at least for the next several months. which I guess RBI is acknowledging will do so. But the loan growth rates will come down quite dramatically from the 30% plus to probably to the mid-teens thing. So yes, valuations will come down, but I think it's still a space to look at because there are lots of good companies out there and valuations have corrected.
A white bucket, what do you look at?
I'll look at those companies which have less of an asset liability mismatch. You look at an M&M Financial Services or a Magma FinCorp, which is corrected like 60-70%, trading at one-time book. Sundaram Finance, a well-run company. So these are the kind of companies that I look at.
No, probably just perspective, maybe housing finance or individual loan profiles, depending on that.
Housing finance companies still, they still LIC still looks good at a 1.5 times book, but if you look at what there is going to be some amount of asset liability mismatch. The housing companies today have the greatest asset liability mismatch, which will correct itself in the coming quarters. So from that perspective, I'll stay away for now, but bit later maybe.
Very interesting. I was just scanning the list of underperformers, and utilities form a large bucket, Chakri, out there. Anything from a Tata Power, despite the moves upwards on a valuation basis compared to the 10-year averages, is trading at a substantial discount. Do you think that discount gets filled? A Tata Power, a Coal India, PFC, REC for that matter, even though they are in news for different reasons?
Yeah. I think it's highly unlikely that the valuation is going to be there. It depends largely on whether the regulators allow a pass-through of costs and a pass-through in their final selling price. Today, all these companies are facing losses. So now, I think that will be the biggest overhang, which is highly difficult to predict. So I think, and if those two things happen, if they're able to pass their costs plus make a profit on top of it, that's the reason why any company exists, should exist rather.
Should exist, yeah.
And so that, but I think that's still far away.
Yeah. Okay, Chakri, we'll leave it at that. Thanks so much for taking the time out and being with us today and giving us your perspectives. Really appreciate your time. And well, on that note, time to slip into a break. Keep in mind the markets are down about 1%. So the Nifty is at 10,686. We're trading at the lowest point of the day. Come back, talk about, a bunch of newsmakers. So firstly, the OPEC meet, and Hisu Lee of Bloomberg News will join us with the expectations ahead of the OPEC meet in Vienna today. We discuss the slowing demand for commercial vehicles with Gopal Mahadevan of Ashok Leyland, and talk about the implications of the new lending rate framework with SBI Managing Director P.K. Gupta.
RP Sanjeev Goenka Group, growing legacies.
Celebrating 100 years of Smile Services Assurance Excellence Commitment. Building beneficial relations with customers and stakeholders. Union Bank of India celebrates 100 years. Thank you for your support.
The final state assembly elections before 2019. 5 states and 3 BJP bastions.
Even if politics isn't front and center for you, this is the one you can't miss.
Will Prime Minister Modi regain momentum after the string of Baipur losses and the disappointment in Karnataka? Will BJP hold its 2014 sweep across Madhya Pradesh, Rajasthan and Chhattisgarh, or stumble?
Will regional leaders let Rahul Gandhi take the lead next year?
Can the party's relentless march into the northeast take down the last frontier of Mizoram?
Will the move to call early elections in Telangana pay off or backfire for Chief Minister Chandrasekhar Rao?
We're going to geek out on all the numbers and monitor each swing.
And find you the tiny shifts which could change fortunes.
Watch us crunch those numbers, sift through all of that data
to tell you why this election is so important.
So do join us on 11th of December, only on Bloomberg Quint.
Welcome back. You're with us right here on Indian Open. Let's talk about the all-important OPEC meet that's happening today. Crude prices have taken a U-turn since the last OPEC meeting, prompting oil producers from across the globe to call for a production cut. Meanwhile, Donald Trump's already made public his displeasure at such a call. But today's meet at Vienna has another factor at play, the controversy surrounding the killing of journalist Jamal Khashoggi. Will the economics and politics of oil result in a production cut? Let's ask Bloomberg's Hisu Lee, who has been tracking the sector very closely. Hisu, thanks very much for taking out the time and speaking with us. Let's first off start off with what the street is expecting out of this meet from Vienna.
Well, the market's generally optimistic that OPEC and its allies will come to an agreement to curb output when they gather in Vienna today. But there are still uncertainties that are keeping investors concerned. We've seen some differing views from major producers such as Saudi Arabia and Russia, while President Donald Trump's continuously adding pressure on the group to keep the taps open. Also, while it's seen that OPEC and its partners will remove production by about 1 million barrels a day from the market, they still need to discuss specific numbers and debate on the scale of the cut that's needed.
Right. What's the chatter around the comments coming in from the Saudi oil minister regarding Russia's support for production restraints being extremely premature at this time, and he won't read too much into it till there are more conclusive actions on it?
Right. That created confusion in the market, causing oil prices to fall yesterday about after the biggest two-day gain since June. Minister Al-Fali's comments came after President Putin agreed that the deal would be extended into next year. His comments suggest that Saudis are probably not happy with Russia's proposal, which implied that Moscow would cut by about a maximum of 150,000 barrels a day, because if that were to happen, that would leave the kingdom shouldering too much of the burden. It also shows that until the group meets and actually discusses in detail about how they would stabilize the market, that is, whether they will reduce output by how much and until when, nothing's really certain.
Right. Okay. Hisu, just one last question before we let you go, and this is, a more political angle to oil now. While we know that Saudi Arabia has the inclination to aggressively cut production, they don't want to come on the wrong side of Donald Trump as well, who has, in a way, helped bail them out in the Khashoggi affair. So is there more politics now to the oil story?
Well, politics continue to play a critical role in the oil market. President Trump could be the biggest hurdle that OPEC and its allied producers need to overcome as he continuously keeps them under pressure. He has once again tweeted on Wednesday urging OPEC nations to keep oil prices low by not restricting production. Saudi policymakers may be reluctant to go against Trump, as he's seen as their few remaining allies in Washington after the murder of Jamal Khashoggi generated intense criticism from American lawmakers. So it will be interesting to see how politics will take a part in OPEC's meeting today.
Well, a large part, I would say. Hisu, thanks so much for taking the time out and joining us and giving us that perspective. Good having you today. That's Hisu Lee from Bloomberg News, all the way from Seoul. Okay, let's talk about somebody all the way from Chennai, I presume. And that's Mr. Gopal Mahadevan, because I think the constant worry in the minds of a lot of people are whether the rising fuel prices, ownership costs, financing woes are hurting heavy truck sales, and they have hurt truck sales in the month of November, and whether this will continue going ahead as well or no. Ashok Leyland for itself suffered about an 18% drop in the truck sales, though you would say that's in line with the industry-wide decline of about 19%. Let's get Mr. Gopal Mahadevan on board to talk about all of this and more. Good having you, Mr. Mahadevan. Thanks so much for joining in.
Good morning.
The simple question, is there a risk to CV growth in the second half of the current financial year?
Well, I think let me answer the question a little indirectly. I was listening to your introduction to this conversation. First, we must understand that the CV has the commercial vehicle industry for the first, from April to November, has grown at about 34%, which is a very, very healthy growth. If you notice that this has been on the basis on over and above last year. November month has seen a degrowth of 10%, but from Ashok Leyland's perspective, we have actually gained share. If you look at the market share of Ashok Leyland in October, it was 27.8. It has gone up to 30.8 in November, as per CM. Similarly, if you look at November of last year, we were at 29.4. So we have actually gained 1.4% over last year. So I'm actually reasonably content of the performance of Ashok Leyland vis-a-vis what's happening with competition. Yes, the industry has degrown, but I'm not too concerned at the moment because, given the level of growth that the industry has posted, you could see 1 or 2 months where, the growth does come off. And we must remember one more thing. Third quarter last year was a stupendous growth of nearly 40%, 42%. So the base effect of Q3 of FY18 will have an impact in Q3 of FY19. The other factors that you mentioned about interest rates, the NBFC crisis, yes, that was also another contributory to this whole thing. But I believe that, those clouds are evaporating. We have not seen any NBFC actually defaulting, and the government is also supporting the NBFC. So possibly after December, you're going to see a lot of things clearing up. As we move forward to Q4, if the infrastructure spends were to continue and, the government has been, making its intention very clear that they will pursue with the infra spend, especially on roads. You have heard the minister state that, they're very keen to have even the Bombay and Delhi route completed. 6-lane, which is actually going to reduce transportation time significantly. If all of that happens, you could possibly see a growth in Q4 also, but we'll have to wait and watch. I'm not too despondent at the moment.
No, so two things, Mr. Mahadevan. One is not just from a Ashok Leyland perspective. Mr. Mahadevan, can you hear me? Mr. Mahadevan, can you hear me? I don't know if we have lost that line. Let me just try one more time. Mr. Mahadevan, I can hear you. Can you hear me? I think we've just lost that line. We'll just try and repatch that line. But I think the conversation is not just from an Ashok Leyland perspective. It's got to do with what's happening on the industry-wide phenomenon, right? Sure enough, Q3 of this year might be impacted because of the base of last year as well. But will the overall momentum in CV sales come off because of multiple factors and not just one? And even if Ashok Leyland were to gain some market share in this period, would the overall growth trajectory come off? I think that's probably the question.
While he did say that they're closer to about 30% in terms of their market share, in Q2 they were closer to approximately 35%. But in October 2018, that actually slipped off from approximately 35% to around the 30% mark. And in a segment that's the high tonnage segment, where they are more prominent in, there is an expectation of a moderation of growth, which is why most brokerages are not factoring in too much of a volume pickup, or market share pickup rather, for Ashok Leyland going forward. Probably if he gives us some more clarity on the higher tonnage segment where they are the prominent, they have a prominent presence, and how that particular segment is shaping up.
Yeah, so okay, that would be one. And two, the impact, Devina, that this slowdown has on the related parties. I mean, we've already seen what's happened to select auto components on the fear of the CV slowdown. Jamna Auto, case in point, largely a CV supplier, and the stock has corrected quite strongly from those 103 odd levels all the way to 67. Some company specific things as well, but that stock has come off quite a bit. I think some of the financing names should also be concerned that what if the CV cycle comes off. And well, there is maybe an economic cycle reason to it as well. It's been 3.5 years now that we've been on an uptrend on the commercial vehicle cycle. Can it come off because it's had such a long cycle? And can there be a moderation or a pullback, which would only be natural? Nothing to worry about, but would only be natural. And therefore, what it does to some of the stock prices.
Another interesting part is, Neeraj, by 2020, the government has mandated that trucks which are older than 20 years need to be phased out. And The management of Ashok Leyland in their recent conference call had said that this problem, gets in a good market for them, and there is a likelihood that they may see growth kicking in because of more orders coming in from the replacement market. But I don't know whether brokerages are too optimistic about that, and whether or not that is a significant point which can lead to an additional growth for them or no, because that replacement market itself may not be as big as an opportunity as probably the management thinks it to be.
Well, maybe a bit later on we'll try and repatch that line. Somehow we've not been able to get through to Gopal Mahadevan. Blame it on the telephone signals, but not being able to get through. I think it would have been important to get those clarifications. We'll try and do that. But Devina, meanwhile, the other important bit is what happened in the in the Reserve Bank meeting yesterday, and the norms for retail lending.
Yep. The RBI has drawn up a new loan pricing mechanism for retail and small loans. The interest rate on all new loans come April 2019 will be fixed based on an external benchmark. Banks have the right to decide on a spread, but the benchmark can't be changed unless there's a revision in the credit rating. Joining us now to talk about the new regime and how it's going to influence the lender's own asset liability management model, the MD of the country's largest public sector lender, Mr. PK Gupta, is joining in right now. Mr. Gupta, thanks very much for taking out the time and speaking with us. While we've been hearing from various quarters that this might not actually be having an impact on the earnings performance of the financials of a bank, it definitely poses near-term challenges in terms of the asset, the pricing, the interest rate pricing and the management of interest rate pricing models for most of these banks.
Hi, good morning. So I think you're right. The initial impact of it may not be large, but over a period of time, actually when the book builds up of the loans which are linked to the external benchmarks, I think so, yes, that would pose some challenge in terms of asset liability management for the banks. But if you look at the instructions that have come out yesterday, so there are only three types of loans which RBI really expects them to be linked to the external benchmarks: the housing loans, the personal loans, and the loans to micro and small enterprises. So most of the personal loans are already on fixed rate basis. So I don't really think that most of them will get impacted by this. But the housing loan portfolio, yes, definitely there will be an impact. But again, I presume it applies only to the new loans. So the portfolio which actually gets impacted by this will get built up over a period of time. And similarly on the micro and small, again the book size is very small, so I don't really think that there would be huge impact. But again, in terms of the benchmarks that are going to be allowed to be used, so RBI has talked about 4. So one is the RBI repo rate, or the 91 days or 182 days treasury bill rates. And the fourth one, they have left it open at this point of time. That is something which probably the banks can work with the FBIL, which is the agency which publishes the benchmarks. So we can see that, if these three don't really reflect the correct position, so what can be the fourth benchmark? I think that is where all the banks will have to sit together and work out which can be the relevant benchmarks that can be used. This is again not something unexpected. This was already there in the works. The Janagraj committee had already come out. The banks had given their suggestions. So from 1st April, the banks were expecting something like this to come out. So let's see how it goes.
So, just as a backdrop, when the since the introduction of the MCLR, there were two problems. Firstly, the banks continue to price old loans using the base rate, while the new loans were priced using MCLR. Obviously, now, do you see this as a solution to that?
No, see, ultimately, if you look at it, I think the problem with the earlier base rate was that whenever there was a change in the base rate, the entire loan book of the bank used to get repriced, while the liabilities take much longer time to reprice. I think the general problem that we have in India is that most of your deposits are actually on a fixed rate basis. See, the CASA doesn't get repriced very frequently. At the same time, even on the fixed deposit side, actually, most of the deposits are 1 year and above actually. So the repricing takes much longer. So the change in the any of the policy rates, the immediate impact on the bank's book is actually very small, because the banks borrow very little money based on the policy rates, either from the RBI or even from the market. Since most of the funding of the bank happens based on the deposits that the bank raise. So unless they get repriced, it is generally difficult for the bank to reprice only the one side of the balance sheet. I think that is the challenge that the banks have. So the MCLR was supposed to be applicable only on the new loans. So in fact, by definition itself, it is the marginal cost of lending rate actually. So here again, the issue I think that is going to really come up is that the incremental loans will get repriced on the new benchmarks. The earlier the banks took care of some of this repricing risk by linking most of the loans to the 1-year MCLR, because that is where most of the deposits of the banks also are. But the moment we move to a 3-month or a 6-month benchmark, the problem for the banks is going to be that you don't have too many of deposits which are actually linked to the 3-month or a 6-month benchmark. So again, the banks may have to do something on the lending, on the deposit side also, to see that the repricing risk gets reduced.
So now obviously choosing the external benchmark, is that going to be solely at the discretion of the bank? And also, I mean, while there are different options of external benchmarks, there are few which fluctuate more than the others. So for example, T-bills are tradable and you will see a relatively higher amount of fluctuation on the rate versus if you were to benchmark against RBI's repo rate. How do you manage, the volatility thereof then?
No, I agree with you. See, the problem with, again, the repo rate is that the repo rate doesn't really reflect the bank's balance sheets at all, actually. On the deposit side, on the liability side, the repo rate linked liabilities are very, very small, actually. So the repricing will not happen if you go by that. You're right that in terms of T-bills, the fluctuations are much, much frequent. So again, that will pose a risk. But again, as I said, they have left a fourth option open. That is where I think the banks will probably have to sit together and work if we can come up with another option which can reflect truly the position of the banks in terms of the various liabilities that we raise and the cost of funds, so that the impact on the balance sheet is minimal.
The other point being, the difference in the benchmarks that the real user benchmarks have versus the financial sector benchmarks. I mean, if you have to take a look at the financial system, they look at T-bills, they look at CD rates, government bond yields, while the actual users, they look at bank PLR, bank-based rates. So does that now solve this problem, put them on the same platform?
No, as I said, first of all, we need to look at what the benchmark is going to be. I think the critical difference which is going to come is that as of now, your MCLR or even the earlier base rate, that included everything. That included the cost of deposits, that included the cost of raising deposits, it included the cost of your credit administration, plus to an extent the profit element. Now, the moment you use any of these external benchmarks, which means that the banks will have to include all the other costs as a part of the spread. So what you see as a spread as of now, which is very little over the MCLR, so the spreads will have to be defined by the banks, and that is what I think the challenge for the banks is going to be actually. As I said, on the other benchmarks, I know what it could be a CP rate, it could be a CD rate, it could be anything. I think that is something which we still need to discuss and debate and decide actually.
Sir, any idea if there probably going to be a reset clause and the frequency of the reset?
No, I think based on what the paper is, I think it's expected is that it will be a 3-month or a 6-month reset. See, if you take a 6-month treasury bill rate, for example, so I assume that it will get reset every 6 months. So that is how the frequency is going to be actually. So whatever is the benchmark, and the duration of the benchmark would be the reset period also.
Mr. Gupta, just one question, not necessarily on this topic alone, but based on the RBI move, it's also mandated a minimum level of loan component in fund-based working capital finance. How does this impact the large borrowers and the banks themselves?
I think this is actually very useful for the banks. Actually, it helps the banks to manage the liquidity much better. It helps the banks to plan their funding much better actually, and it brings in some kind of discipline. So you have seen in the past there are borrowers who enjoy very substantial limits, but they hardly use them actually. And then on certain days, suddenly huge demand comes, which makes it difficult for the banks to manage liquidity. I think for the liquidity management, as well as to bring in some kind of credit discipline in the market, this is, I think, going to be very, very important. And particularly going forward, as the banks will have to maintain capital on the unutilized portions of the limits also. So I think this will help both the banks and the corporates to plan their limits much better.
Okay. Mr. Gupta, thanks very much for joining us. Really appreciate you taking out the time and having this conversation with us. It's an important one. That's the management at SBI talking about the implications of the announcement made by the RBI yesterday. With that, markets right now down under by almost more than 1%, 10,665 on the Nifty. So steep cut from those levels of 10,750 that we were at yesterday. Sensex also down close to 2%.
Yeah, it'll be interesting to see what happens when Europe opens, Devina, because I don't think European markets had the luxury of reacting to the Huawei news, and if indeed the European markets start off further weak, then there could be some more downsides as well, because yesterday, you would remember as well, we exaggerated our losses after European markets opened about 1.5% lower. Interesting to see what happens there. Just a couple of movers and shakers. So Eicher Motors is down another 2.5%. Maruti Suzuki's cracked another 2.5% as well. Some financial names like Kotak Bank also correcting. It's the top loser from the financial space. Actually, no, Indiabulls Housing Finance gets that mantle, but Kotak Bank too down about a couple of percentage points. The broader end of the spectrum, I think obviously the quantum of losses for select mid caps would be high, but you just see 2 or 3 names which are above 5%. So NCC is down about 8.5%, Just Dial is down about 5.5%. But aside of that, we don't see too many stocks which have corrected dramatically, 3-4%, the likes of M&M Financial and DLF, etc. So that's the set of names that you got to keep at the back of your mind. On the gaining side, there's probably only one set of stocks, or the 2 names which deserve a mention. Sun Pharma bouncing back a little bit, 2.5% higher, and Sun Pharma Advanced Research, I presume, would be slightly higher, should come up on your screen, just about 0.4%. So just these couple of names which, stand out in trade. Wrap it up on this leg of Indian Open from Devina and me and the team that put this show together. Thanks so much for watching. Stay tuned. The FNO show takes over the action on the other side.